Hello and welcome back, everyone. Thank you so much for joining me. Today I have a very, I would say, concerning news for you about the banking system here in the United States. The Federal Deposit Insurance Corporation, or FDIC, issues quarterly reports, as you know, and the most recent one is far from good. So let's get straight to the point. The FDIC report reads, unrealized losses on available for sale and held-to-maturity securities increased by $39 billion to $517 billion in total in the first quarter alone. Higher unrealized losses on residential mortgage-backed securities resulting from higher mortgage rates in the first quarter drove the overall increase. This is the 9th straight quarter of unusually high unrealized losses since the Federal Reserve began to raise interest rates in the first quarter of 2022. So I would like to draw your attention to that phrase, the 9th straight quarter, not month, but quarter, the 9th straight quarter of unusually high unrealized losses. And unrealized losses are losses that you have not taken, right? They're just sitting on your books and you're waiting for better times so that you don't have to show that loss on your income statement. That's what essentially this means. So why is this a big deal, you may ask? Well, this is very bad news due to several reasons, and I just want to walk you through those reasons in this video on a very high level, of course, without going into too much detail to bore you. So first of all, this means that banks are likely to have liquidity issues moving forward, meaning they will struggle with having available cash to meet their short-term obligations, such as your deposit withdrawals, for example, and that's terrible news for everybody. The second thing to consider is that banks make money primarily through lending. So liquidity issues actually prevent banks from being able to lend, because regulators require them to make a provision for bad loans, or in other words, reserves. And so those reserves are usually based on a very specific formula that factors in their current delinquency rates, associated risks, their forecasts moving forward, etc., etc. So we should see bank reserves rise when banks report their second quarter financial results here in July next month. Having adequate loan reserves is absolutely key. This is what will ensure that if an unforeseen event takes place, banks will leverage their reserves against their losses or the need to come up with a large amount of cash in the event of a bank run, for example. But that's not what we're seeing right now, unfortunately. And this is bad news for us too. As economic conditions deteriorate, banks actually now have smaller reserves on their books, smaller than they were even a year ago. International Banker here reports the Federal Deposit Insurance Corporation, FDIC, revealed that U.S. banks currently hold $1.40 in reserves for every dollar of delinquent commercial real estate loans, which is significantly lower than $2.20 for every dollar of delinquent loans recorded a year ago, and the lowest level in more than 7 years. If that is not a recipe for a disaster, I don't really know what is. Additionally, FDIC just reported that the loan growth is declining, just as I mentioned a minute ago. It reads, the industry's year-over-year loan growth rate of 1.7% is the slowest rate of annual growth in the banking industry since the third quarter of 2021, and it has steadily declined over the past year. So there you have it, tighter lending standards along with less than exciting forecasts for the future and consumers being already absolutely loaded with household debt to where they may not even qualify for new loans. All of those factors resulted in the slowest loan growth rate since 2021. And this is very important because this is the primary way for banks to generate revenue. Now, FDIC is starting to admit that commercial real estate loans are not doing well, and this is going to become a big issue. This is a huge red flag that I would really love for you to pay attention to. Here, FDIC reports asset quality metrics were generally favorable, and I have to stop here and just let you know that I have no clue what generally favorable actually means. This is just a sugar-coated way to say that things are not really going well, to be honest, but let's move on, and I would like to draw your attention to the second half of the sentence. So generally favorable with the exception of material deterioration. And material deterioration is actually significant deterioration in commercial real estate and credit card portfolios. This is such a big red flag. It is very sugar-coated. That was certainly very, very sugar-coated. But material in financial terms certainly means significant. High office vacancies have been driving down the price of commercial real estate, and primarily those office buildings that are no longer fully occupied due to flexible work arrangements. And because they're sitting vacant or half vacant, landlords are not really getting the same cash flow anymore as they used to. So they're effectively losing money on holding on to that real estate that nobody really wants. That is really, really bad news. But the worst news is that as these buildings are not fully occupied, they are actually the collateral for these mortgage loans. And as they decline in value, it means that the loan is not really secured anymore as well as it should be according to compliance standards, to lending compliance standards. That is a very, very simple way of explaining this, of course, but I think that it shows what's going on, and that is my primary purpose for this video. I have multiple videos here on my channel about commercial real estate loans and the risk that they pose to the overall banking industry. And if you're interested, you're welcome to browse through the videos on my channel and take a look at those videos. One thing I would highlight here is that the longer interest rates stay elevated, and we know that inflation is not going away, so it is a tough position to be in, but the longer rates stay elevated, the more trouble we will see in commercial real estate lending, and the bigger impact it will have on the financial sector, on the banking industry specifically. According to International Banker publication, the average reserves of JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Goldman, and Morgan Stanley fell from $1.60 to only 90 cents for every dollar of commercial real estate debt on which a borrower is at least 30 days late. This is just terrible. This means that delinquent commercial real estate loans, which tripled to $9.3 billion for the 6 big U.S. banks over the last year, have now surpassed, and please pay attention here, have now surpassed the amount of reserves being held at those banks to cover them. They don't have enough reserves to cover those bad loans, which could prove hugely problematic should those loans end up in default. In late March, S&P Global warned that there is now a high chance of regional lenders seeing their asset quality eroding by the stresses related to commercial real estate loans, and that an increase in the number of so-called modified loans, and this is where a lender makes concessions to help out the borrower. So if we see a rise in modified loans, we will also see a decline in asset quality, which means, again, this is bad news, very, very bad news for the banking industry, and specifically for those mid-sized regional lenders. These deteriorations are signs of things to come, with more stresses and failures expected over the coming months and years that could well plunge the U.S. banking sector into yet another crisis. Should interest rates remain elevated and property values fail to recover, loan default rates might reach or even surpass the levels seen during the 2007-2009 global financial crisis. Depending on the magnitude of defaults that transpire, the resulting banking sector stress could ultimately trigger a wave of failures among lenders. So as you can see, even though we don't hear much about this in the media, there are major events that are unfolding that will likely become increasingly obvious in several months when we see more of these quarterly reports published and when we see latest numbers being available to make it absolutely clear that we might be in for something bigger than the 2008 financial crisis, unfortunately. Thank you for watching. I hope that this video was helpful and you learned something from it. Remember to like, subscribe, and share. It helps out a lot. I would love to have you back for my next one tomorrow. And I hope that you enjoy the rest of your day. Take care.